It's very difficult to do. Now, if you come back to this other innovation of shelf registrations, what you can see is before we started selling digital credit, the largest shelf registration on a credit instrument in the world ever in the history of the market was $500 million. And then Strategy created a $2 billion registration for Strike, a $2 billion one for Strife, a $4 billion one for Stride, and then a $21 billion shelf registration for STRC. And so you can see here that innovation, that idea of a shelf registration on a credit instrument, it was not materially used by anybody in the world in the capital market. And the truth is the US is the leader in shelf registrations. So when I say in the world, I mean, they're not doing it in Japan, they're not doing it in Europe. The US is the leader, and in the US, we've just did something which is 40x bigger than the next biggest thing that's ever been tried by anybody. And again, we're not even 1 year old. Why? Why is there so much demand? Well, private credit yields 8.5%. You could characterize the entire credit market as return-free risk. You're getting 80 basis points of yield over the risk-free rate if you buy investment bonds or corporate bonds. You're getting 200 basis points for junk bonds. You're getting 300 or 400 basis points for private credit that's illiquid. It's all taxable. And we come up with something which pays 11.5% that's tax deferred, that's liquid, that's transparent. If you're a taxpayer in Miami Beach, that's the equivalent to a bank account that pays you 18%. Now what you see is we've created the short end of the yield curve, like the 1 month Bitcoin bond, the risk-free rate in the crypto ecosystem. So what is the free market rate of capital, or the free market cost of capital? It's 11.5% right now. And you can see what the risk-free rate is in every other currency. 3, 2, 1, 0. And now if you're an investor, you can start to imagine a world where I borrow euros at 2% and I buy STRC at 11% and I keep the difference. Or borrow yen at 70 basis points and invest at 11% and keep the difference, right? There's a massive arbitrage here. What if you live in New York City? Stretch is like a bank that pays you 24% interest in New York City, right? What if you live in San Francisco? 23.1% tax equivalent yield. Your money market pays you 3.6%. The bank deposits pay you almost nothing. Why wouldn't you buy it? Volatility. It's too volatile. You can see we've actually taken the volatility from 13 down to 2.3 through the end of April. Our goal is to get it into the ones. We've had it into the 1 range a few weeks ago. The only instruments in the entire credit industry that have a 1 volatility are money markets. Now, it's worthwhile to talk about some financial theory here. The Sharpe ratio is defined as the return of the instrument minus the risk-free rate divided by the volatility. So it tells you how much you're getting paid for the volatility that you're incurring or the risk that you're taking. What is the risk-adjusted return? When the Sharpe ratio is above 1, you're getting paid more in return than the volatility you're incurring. And what you can see here is the Sharpe ratio of Stretch is 2.7. The best Sharpe ratio of a credit instrument is 0.5. Right? It's 5x better than the next best credit instrument. It's 10x better than most credit instruments. The money markets have a negative Sharpe ratio. The fee charged to you by the issuer or the sponsor of the money market is so high, 20 or 30 basis points, that this is in essence, there is no return. It's return-free risk, negative Sharpe ratio. Compare digital credit to equity. The best equity in the world is NVIDIA. NVIDIA's got a positive Sharpe ratio, 1.89 right now. Nobody else in the Mag 7 does. None of them return the risk that you're taking. Amazon, the volatility is 5x the return. Stretch is outperforming them all. And it's a credit instrument. Imagine doing that with credit. And now let's look at assets. The S&P index doesn't return its volatility. It's got a Sharpe ratio of less than 1. Bitcoin, it's got a return lower than its volatility right now. NASDAQ, same thing. Gold, 0.4. Real estate's awful. right? It's got high volatility, low return, 0.17%, really weak, 17 basis points. So you see, Stretch has got a higher Sharpe ratio than any of these instruments. In fact, it's kind of like monetary fuel. And that means it competes with $300 trillion of credit, $100 trillion of equity. It competes with real estate. Digital credit is going to cannibalize, it's going to replace real estate capital, equity capital markets, credit capital markets, currency capital markets. And you can see here on the screen, most of them are just sitting with very lackluster yields, and all sorts of risks and opacity, some of them illiquid. None of them compare favorably to digital credit. You can see it on the chart here, right? You walk down the street and ask 100 people, do you want a 30-year bond? Do you want something you got to hold for a decade and see if you get wealthy on it? Or do you want a bank account that pays you 10%? And the answer is everybody wants a bank account that pays them 10%. Some people that are specialists might think they can do better than that with some of their money. But every corporation, every individual, every institution has a lot of money they want to put in a bank, preserve the principal, and they want to get paid 3 times the money market rate or 4 times the money market rate. One of the serendipitous results of digital credit is you can buy digital credit, you can collect the dividends tax-free, tax-deferred, you can reinvest them tax-deferred, and you can compound your wealth in a tax-deferred basis on a credit instrument, which normally you can't do it with a bond. You can't do it with a preferred stock that's a normal qualified dividend distribution.